90% of all payments in the world, import-export payments, is done in USD. And USD can only be cleared by 5 banks in New York. If you cross those 5 banks, your USD won't be cleared. You are out of the game. Very, very serious consequences. So US says, this is the rule now. Everybody follows suit. I'm not just talking about emerging markets like Turkey or something like that. I'm talking about UK, Europe, everybody.
That's Berhan, co-founder of Keyrails, a payments infrastructure company that connects fragmented financial systems of emerging economies to the global banking highways of SWIFT. With a background in cross-border payments and stablecoin infrastructure, Berhan has spent over a decade building financial solutions across Africa, Southeast Asia, and beyond. In this episode, we break down the real mechanics of global money movement, from the limitations and benefits of SWIFT and correspondent banking to the true impact of stablecoins on cross-border transactions. Season 3 of Stableminded is powered by Defense, the leading multi-chain wallet platform helping fintechs, banks, and enterprises manage digital assets securely. More than 130 global clients secure over $1 billion in monthly volumes through Defense. Manage governance and compliance, automate workflows for approvals, and unify your APIs, all within a platform that has a perfect security record. Access a broad network of ecosystem integrations. From compliance tools like Chainalysis to exchanges like Coinbase, Defense integrates seamlessly with all the tools you need. This season, we sit down with the co-founders of Defense to dive deeper. All right, Berhan, how are we doing?
Great. Thank you.
I'm so excited to have you on. Thank you so much for taking the time. There's a lot to talk about with Keyrails, what you're building. It seems like there's a ton of momentum building with the company and the product, just based on a couple of the things you've already mentioned to me as we were getting going here. So super thankful that you've decided to join us on the podcast.
Yeah, glad to be here. Thank you.
Why don't we start with your quick intro, your full name, what you're doing at Keyrails, and then a quick introduction of how you describe Keyrails high level, and then we can dive deeper.
Yeah. So I'm Berhan. This is my 15th year as an entrepreneur. And my previous venture is ARF.one, which is a short-term USDC lender to other cross-border financial institutions, which is a big company right now. I exited my position there 1.5 years ago and started Keyrails with my co-founder Raj. And we've been dealing with stablecoins since 2018, at least. ARF started as a payment network built on top of stablecoins. And when we first started playing around, ERC20 was barely 6 months old. USDC didn't exist, and USDT was running on top of Bitcoin only. So in crypto years, I'm like 85 years old. All this talk right now about stablecoins and stuff, the sandwich model, etc. We tried all of it. So I know where the traps are, where the bodies are buried. I'm coming with a lot of heavy experience here. I mean, these lines are from stablecoins, to be honest with you.
Wow. Yeah. So, Well, first off, thank you. I know you've been building in this space for quite some time. I think, to your point, there's a lot of excitement right now. You're on a stablecoin focused podcast. The idea of that a decade ago would be ridiculous. Even a couple of years ago would be probably ridiculous.
Yeah.
So I think for us, just the next 30, 60 minutes, however long we go here, I would really love to help really with your perspective, give context. I think a lot of people are coming into this conversation for the first time. This is like, and this show and this brand for us is really like, hey, we want to be an entry point. We want to help people get up to speed. You want this to be fairly high level of a show in terms of giving people a first stop in the journey of learning about this, because a lot of people right now are very early, but you are not. You have been doing this for quite some time. So what do you, maybe just to start there, what do you think are some things that are potential misconceptions? I was reading your recent LinkedIn post from a couple of weeks ago, just some misconceptions about the space that maybe someone who's entering it or thinking about it for the first time, you are finding might be off. Maybe we start there, or things that you're hearing that you would reframe.
First of all, let's just get things out there. Stablecoins are one of the biggest inventions in recent years in all the financial industry, maybe in the last decade, after e-money probably. So let's get it out there. But the problem right now is they are very, very complicated, actually, much more complicated than people think right now. So on paper, what people are thinking right now, what we call the sandwich models. So Swift is slow, Swift is expensive. So we just convert everything on the local side to stablecoins, push the stablecoins across the other side of the world, like overseas, and convert it back to fiat and just settle it. That just doesn't work for most use cases, actually. So that's how we started in 19 with Tether, actually, because USDC didn't exist back then. So, and that's how we started, and quickly saw, of course, there was no liquidity back then. It was all wild west. I mean, there was no compliance. Nobody knew what a stablecoin was. We barely even knew it, what stablecoin was and what they are capable of. And we were just experimenting back then. So there's nothing in comparison to then and now in terms of liquidity, the mindset, etc., and how actually the traditional big players like banks and stuff approaching stablecoins. But the first misconception is how we see the stablecoins. So the first mistake that we did was we had, for example, the fastest Europe to Philippines corridor. So euro to stable to peso. So it was like lightning fast. We built it with Stellar Development Foundation, and it worked great. It was directly, not even Stellar blockchain, it was directly built on top of the SEP31 protocol of Stellar. That was protocol level rail. That is the hardest thing to do. The problem was our conception, and today's one of the biggest misconception is USDC is USD, or stablecoins are USD. When I say stablecoins, I'm always referring to dollar-based stablecoins. Okay, that's the only relevant stablecoin for payments. So, and mostly I refer to USDC. That's more payment grade stablecoin, and USDT is more like financing grade stablecoin and moving treasury kind of stablecoin. So when we first did that, our first misconception was USDC is USD, so it should be treated as the same when I'm converting USD to peso from USDC to peso. So I should get about the same price. That wasn't the case. The problem that we missed, that was a big elephant to miss, by the way, but it was, wild west and we knew nothing, is USD has, of course, big, all right, very liquid and used by banks. So banks provided a lot of USD liquidity. USDC, on the other hand, especially in those times, were just very small and used only by, some obscure exchanges, brokers that also were experimenting like us. So there was no liquidity. So the spreads were great. What we did was, our pricing was USDC to peso was like 0.50%, which was like 0.60% more expensive than the next best, next more expensive USD rail. And everybody knows, especially if you are doing B2B, 60 basis points, 0.60 is, you can't come back from that. We immediately got priced out of the market. The problem was, we didn't know why we got priced out of the market, because it was so fast and the experience was so great and we were doing volume. Don't get me wrong, we were doing volume. Not big volumes, but we were doing volume. And we didn't know why we got priced out of the market. Then we dived into it, and it took us some time to understand how actual correspondent banking and the old school infrastructure in cross-border worked. That brings us to today. See, people are still having some, problems with the necessary know-how about cross-border and payments in general when it comes to stablecoins. So let's leave stablecoins for a minute there. Let's dive into the killer use case of stablecoins, which is cross-border payments, right? Fundamentally speaking, there are three ways to do cross-border payments, okay? One, you do the SWIFT, okay? That's what everybody's talking about, 2-3 days, a lot of intermediaries. First of all, SWIFT, maybe 90% of SWIFT actually settles the next day. And maybe 95% of SWIFT uses either no intermediary or maybe one intermediary, okay? SWIFT has gotten very, very good over the recent past few years. So that's the concept of this old school 70-year-old network that does things like in a week and it costs like a fortune to do is not necessarily true if you are operating in, for example, in the US, Europe, Singapore, all those places, or UK, all those places. SWIFT becomes extremely problematic if you are originating from an emerging economy. That's where the problem is with SWIFT. So if you're pushing US to Philippines, you don't need stablecoins. Trust me. I will explain in a minute why you don't need stablecoins. I will explain exactly how that infrastructure works. US to Mexico, US to Philippines, US to anywhere, basically. You don't need stablecoins for that. And you can use it if you are combining it with some other products, that is based on stablecoins, that's fine. But if you're only doing payments to those corridors, you don't need stablecoins for that. Well, you can use it, but you will be priced out of the market immediately. But the problem is, if you're originating from emerging markets like Mexico, we originate 70% of our payments originate from Nigeria. Then it becomes problematic for two reasons. One, if you say I'm originating from Nigeria, you immediately lose like 80% of the entire world's financial infrastructure. Everybody will say, no, you're not touching. Okay. That's just habit. Okay. That's just habit, because why would he? Because he has already a lot of volume coming from the US, from London or from Singapore. Why would he touch any Nigerian flows? He wouldn't. So you are restricted to like 15 to 20% of the entire financial infrastructure. Two, it is ridiculously hard originating payments from emerging markets because they lack dollars. They don't have dollars. It's very hard to find dollars in Nigeria or in any of the 50 sub-Saharan African companies. They just lack dollars because they have so much imports and so little export. They always lack dollars. So you need to have this really, really, really optimized system to just source those dollars, and banks can't do it. That's the problem with SWIFT. So SWIFT is mostly associated with banks, and since banks lack dollars, they can't even start triggering the SWIFT because they first need to source the dollars. So SWIFT becomes very problematic. That's the first way. So do the direct SWIFT, that works, but it is really, really slow and really expensive if you are sourcing from an emerging economy. It works perfectly if you are doing US to Singapore. US to Singapore, Barclays to DBS, for example, it will take like under 30 minutes. It will cost you like $10 to do a SWIFT transaction. Okay, that's a solved problem. You don't need stablecoins for that. So the second way is the most common way of doing cross-border is the pre-fund model. Okay, that's how Terra works, Tunis works, all the big guys like Wise, and most of their transactions are pre-funded. So that's a very basic model. So you are in country A. Okay, you're licensed there. You're collecting a lot of stuff or a lot of payments, and now those payments needs to, move. Of course, moving is SWIFT, and it's very expensive, so you don't move it. What you do is you move them in bulk before you make the transactions. Okay, so a country B where there is a licensed partner of you. Okay, we call this the nostro model, the nostro account. Nostro means it's a very fancy word. It means ours. Okay, nostro, it's ours, yours. It's an accounting thing. So to a nostro, but we call them a nostro account so everybody understands what they are. So to a nostro account, okay, and start waiting for those instructions. Okay, so let's say you're a remittance company. Okay, you do like your average is like what, $500, $1,000 per payment. Okay, you move $1 million, so you are now waiting 1,000 payments, $1,000 each. Okay, and then when that drops to $250,000, you send another $750,000 and top it up to 1 million, and again start waiting. That's an incredibly fast model, but it gets stupidly complicated if you are serving more than 20 markets. Okay, so if you are not Wise, okay, and you are trying to compete with Wise, you need to go for an aggregator who already solved that problem, okay, for you, because let's say you need to send $1 million. You have $1 million, $500,000 in Singapore, 500,000 in Germany. Now, cumulatively, you have $1 million, okay, in your account. Now, let's say you have an instruction for $1 million in Germany. You have to reject it. Although you have the $1 million, it's the wrong place. $500,000 of it is Singapore, which is 7 hours ahead of Germany. You can't take it back. So you have to reject the instruction. So you have to have $1.5 million to just settle $1 million. And that's a very inefficient model. There are $4 trillion as we speak, just sitting in those nostro accounts as we speak. That's a lot of money. That wasn't the case when I first started, because we had this phenomenon of zero interest. And those nostro accounts didn't cost us much because the cost of capital was so low. But right now, it's like 4.5% for US Treasury. Now, they are costing us a lot of money to keep that money there. And only a handful of companies can provide you, savings account and stuff like that. That money is sitting there and making money while it's waiting for the instructions. Maybe 1% of the market can provide you that. The remaining 99%, it just sits there doing absolutely nothing. Okay, that's the second model, and mostly widely used model. The third one and the last one is net offs. Okay, now like 25 to 30% of Wise transactions are net offs because they are so big. net offs are usually work when the supply and demand are pretty much equal. Okay, you can't net off anything when the payment is going from the US to Philippines because it's all US to Philippines. Nothing comes back from the Philippines to the US, so you can't net it off basically. So you need to find some other way to net it off. So usually it works like from US to Europe, both are very liquid. You can net off a lot of payments because they are mostly equal. Okay. So net offs are usually, it can't exceed like 20% of your transactions. That's just math, how the math works. So I have three ways. So there's the SWIFT, the pre-fund model, and the net off model. That's the only three ways you can move money. Okay. So enter stablecoins. So where do we penetrate for the stablecoins? So like I said, which brings us to companies like Keyrails that offers the stablecoin infrastructure. So if you're making payments from US to Philippines or US to Mexico, okay, here is how the big remittance companies do it. Okay, so you are a remittance company, let's say, they are operating out of Philippines. If you are an important remittance company that has enough volumes, like say 100 mil per month, okay, you go to a bank, local bank, that has a correspondent account in the US, like Citi, JP Morgan, doesn't matter. There are 5 big correspondent banks in the United States, in New York, okay, that have an account with that bank. When I say correspondent banking, it's again fancy word. It means a bank has an account with another bank, okay, which is usually the US bank because USD needs to be cleared. So the model works. You go to this bank and say, I'm going to give you a lot of money, a lot of USD in the United States. Now, dollar is very valuable when it's in the United States. Dollar is not very valuable offshore, okay? There are two things that you can do with dollars offshore. You can show it to another bank and get credit against it, okay? Or do very expensive payments. Like if you're buying a yacht, okay, in Greece, you can use your dollars in your Cayman Islands account. That's
But
what
it doesn't have utility, you mean? It doesn't have a lot of utility.
Exactly. But if you have dollars in the US, that's very valuable because you can go into NASDAQ, you can buy a lot of US treasuries, you can go to the money market, and US is by far the biggest money market in the world. Okay, so having USD in the US is a very valuable thing. The second thing is, in emerging markets, like I said in the beginning of this conversation, they are hungry for dollars. So their central banks get dollars from swap deals on top of the exports. Usually when the imports exceed the exports, they have to do a lot of swap deals. They have to get USD from somewhere else to pay for the imports. Okay, so USD becomes a very scarce resource, and the central bank says you get this much USD, you get this much USD, which is very bad for the bank because the bank makes money from the USD. They want to send payments to China, for example, okay, because they have the demand for it, but they can't find USD because the central bank is not giving it to them. So if you go to this bank and say, I'm going to give you USD in the US, that's an incredible valuable thing because it's outside of the purview of their central bank. They can tell their central bank, I have USD in the US, but I'm not sourcing the USD. And the central bank is very happy, so they don't have to give it to this bank more USD. So everybody's very happy. So you go to this bank, say, I'm going to give you USD in the US, but I want something in return. I want incredibly cheap local currency. And banks have this superpower. They can create local currency through fractional reserve banking. They don't have to have that. They can create the local currency against their deposit using a leverage multiplier. So if they have $1 million, okay, in deposits, they can lend out $5 million at almost zero cost, and they make money from the net interest margin, basically. And emerging markets, if you are getting interbank, so interbank means the exchange rate that is used between the banks in that local jurisdiction. Mid-market means, which is higher, what these banks are getting from the outside remittances, B2B payouts, etc. So there is always a difference between interbank and mid-market when you are doing FX. Interbank is always lower than the mid-market. And depending on the volatility of the currency, that gap widens. For example, I'm Turkish, born and raised. And Turkish lira is a very volatile currency. It usually is like 40 basis points between interbank and mid-market. But mid-market is what you see in Google, Morningstar, and interbank is what you see on the central bank buy rate. So there's always like 30, 40 basis points between them. And if the currency goes crazy, sometimes our currency goes crazy, like twice a year or so, it can be up to 1%. So if you're getting like 10 basis points on that, and it is an incredible pricing, no one can beat that because if you are sourcing your pesos from the mid-market, the best you can do is mid-market. And those guys are already 30, 40 basis points below you. You can't beat them. And that's the cheapest way, absolutely cheapest way to send money to any jurisdiction. The problem with that infrastructure is you can't scale it. You have to be licensed in that jurisdiction because the bank will only onboard you if you are licensed in that jurisdiction. There are a couple instances that is not the case. Like in the US, you can do sponsor banking. The bank will, provide you the licensing coverage, but you can't do that in Southeast Asia, Turkey, Europe, nowhere. That's a very US thing to do. So you can't scale it. One, you can't get licensed everywhere. Two, the banks won't play the role of a switch to make payments on behalf of you because they won't trust you because they are, as a Philippine, licensed company, you can't do the same thing in Vietnam without getting licensed in Vietnam. So if you are looking for remittances and using stable coins, okay, those corridors that get a lot of remittances, there are at least 2-3 players playing the game like that. And you can't beat them with stable coins. Because with stable coins, the best you can do is you can get mid-market, maybe go to Circle, get 0 trade rates, but you will still get killed by the FX rate on the mid-market. All right. So you need to go to a bank, get converted to USD. You need an intermediary there that converts the USDC to USD, get the USD, and then you give the bank the USD so they can give you a good rate so you can compete. Okay. So that's where most misconceptions of stablecoins are. So today's conversation is all about, we have this slow, very expensive system. Now we have stablecoins. It will immediately get very fast, very cost efficient all of a sudden. It won't, because we've been trying to do that since 2019. And it works in very, very specific circumstances. Lucky for us, okay, those circumstances are expanding. In 2020, we are doing right now as Keyrails, doing things that we couldn't even dream of in 2020. I mean, those conversations remained at bars while we are drinking beer because it was impossible to execute them. I mean, we would go to jail if we executed them. Right now, we are getting enough, inflation, regulatory clarity, okay? And US is changing. One thing everybody needs to know, US is the king. Okay, everybody follows US. What US does is the rule. Nobody gets out of the US what US says, because no matter how big the country is, how rich the country is, everybody needs to clear USD. 90% of all payments in the world, import-export payments, is done in USD. And USD can only be cleared by 5 banks in New York. If you cross those 5 banks, your USD won't be cleared. You are out of the game, out of the import-export game. All of a sudden, you are looking for, empty market shelves and stuff like that. So it has very, very serious consequences, okay? So US says, this is the rule now. Everybody follows suit, okay? Let's get things very, very clear here. I mean, I'm not just talking about emerging markets like Turkey or something like that. I'm talking about UK, Europe, everybody. Okay, everybody looks at US. If US is fine with a certain, payment model, all of a sudden you will see everybody is fine with that. We are seeing that right now. I mean, 6 months ago, I was doing Keyrails. I had the same infrastructure and I was going to banks and stuff like that. They were like, we don't think so. And obviously they were right, because we do a lot of emerging markets. Our reason of existence is in emerging markets, basically, like Africa. But right now we go to them, that's great, stablecoins, you want to learn from here. All of a sudden, the sentiment has shifted so far. It started with Bridge. Okay, they started the wave, and then Trump came in and it turned into a tsunami. Okay, now everybody's talking about stablecoins. It served well for us. I mean, we are growing exponentially at the moment, but but
you really feel a tipping point, like since November.
Exactly. I mean, 2025 will be, as wild as 2018 within a certain patience and rules and regulations and stuff like that. It's out there right now. It's not in the fringes of financial markets, or it's not in the hands of crypto bros or anything like that. Really, really serious people are, emailing me, WhatsApping me, to find out how our infrastructure works and I'm talking about the biggest B2B payout companies and remittance companies right now calling us to see whether there is something to be done with stablecoins. 6 months ago, that was That was unheard of. That wasn't even a thing to dream of. And right now it's like, we are all of a sudden in the middle of the entire financial infrastructure. When you're talking about financial infrastructure and payments, like in volumes like quadrillion dollars, like 1.8 quadrillion or something like that, and it produces like $20 trillion in revenues. It's the biggest market in the existence of humanity, basically. But like I said, so we need to, the market needs to learn before we are jumping on trying to solve everything with stablecoins. We need to understand the intricacies of cross-border payments, not in terms of liquidity, in terms of effects, in terms of regulations, in terms of licensing. A lot of things that you can do in the US, you can't do in, Singapore or Hong Kong or Nigeria. A lot of things that you can't do in the US, you can very easily do in Hong Kong, for example. So you need to learn to navigate those. And then there are the global regulations like travel rule, for example. And you are mixing crypto with fiat. Okay. And now everybody's very confused about the travel rule, how it will work. And we see a lot of very funny interfaces about travel rule right now because it's in effect right now, especially in Europe. So we see a lot of, very funny questions that we are receiving, and that is impossible to answer, but we have to answer them. So but it will grow exponentially because stablecoins, the way we do them right now is very specifically, we do a lot of import-export. We do high-value payments. We excel at emerging economies. When we say we excel at emerging economies, usually most of the companies mean on the payout side, like we are paying out, we are excelling in originating side, which is like 100 times harder to do when it comes to emerging market, originating the payment from an emerging economy. And the way we are using stablecoins, especially in Africa, for example, we are creating liquidity with all our partners from outside of Africa because there is no liquidity inside of Africa. I mean, when I say liquidity, USD liquidity, so hard currency, there's a very simple reason why we are not using dollars but stablecoins is stablecoins, there are usually two sides of the transaction. So one, you convert the local currency. I'm going back to the sandwich model. So you convert the local currency to stablecoin. There's no problem in that because everybody wants dollars. Since everybody wants dollars, they are willing to pay the premium for the dollars. Okay, so there is no pricing issue on that. You will never get priced out of on the incoming on the on-ramp side. So it's easy to solve problem. The problem is on the payout side. Okay, so we are a global infrastructure. We basically settle Swift GPI transactions, so same day Swift GPI transactions to all of the countries in the world, except for the 5 OPEC Section 1. We pay out everywhere on the same price, on the same settlement times. So now we can't work with dollars because where do I settle the dollars? So when I pull the money out of Africa, and let's say I decided to settle in dollars, where do I put the dollars? I put it in the US, okay? All of a sudden I get an instruction to China. China is like 13 hours away, 13 hours ahead of US. So that time difference makes a payment so difficult. And then I put it in Dubai. All of a sudden I can't get the money out of Dubai. Okay, I got all these questions because, if you're pushing the payment to China, it's fine. If you're pushing the payment to the US, all of a sudden the banks get jittery. Okay, because they don't want to lose their correspondent banking relationships with Citi and JP Morgan. So they are very careful pushing money out of Dubai to US. So the best way to do that, stablecoins are like the quantum mode of the dollars. Okay, at any given time, they are in the cloud and everywhere until they collapse to a threat by reality, which could be China, which could be Vietnam, which could be Dubai, which could be US. At the moment of the transaction, before I get the instruction, I don't care if I'm holding USDC because USDC is neither in China, nor in the US, nor in Nigeria. It's everywhere. It's in the cloud. It's the best thing that has ever been built in the financial industry, actually. Well, the second best thing after Bitcoin, obviously. But it's incredible. I mean, e-money, US doesn't have e-money, but Europe is big on e-money and it's very well used in Europe. E-money was a big jump in terms of payments in Europe, okay? But stablecoins are like 100 times a bigger jump. It's like a quantum jump, basically, in terms of payment infrastructure. Because right now, I mean, when you have the stablecoin, not just collapses anywhere, it can remain as stablecoins like most of the Africans want it. It can serve as a pan-African settlement currency because there is a lot of problems in Africa too in terms of their banking infrastructure. So a lot of young merchants use only USDC or USDT to settle among themselves because their local payment rails work. Same goes for Latin America, actually, but Latin America is a bit better than Africa. Africa is the most difficult market in the world, hands down. And I worked in all of those markets. I mean, I worked LATAM, I worked Africa, I worked Philippines, I worked all of these markets. Africa is by far the hardest one that I worked in. But there is more to it than that, actually. So I can't talk about it too much because it's only closed beta right now with a few clients, but we are building something with Anchorage, okay, and through their portal team and Anchorage team that actually will change the conception about stablecoins for local payments, okay, like local US payments. Right now, everybody thinks stablecoins, when you say stablecoins, it's all cross-border. That's just not true. So stablecoins are much more than that. We just are not there yet because we are still trying to understand the cross-border market. But people like me who already understood it a few years ago, now I'm focusing on how it can be used in local market, especially the big ones like the US. So we are building something for it, and we are writing a case study, and we are doing a lot of tests, and they are going much better than I expected, to be honest with you. And it will have a big impact on US local payments, actually. The ACH payments, Fed wires, and people will see it will take some time to get some adoption to that, for people to wrap their heads around it. But it is, incredibly innovative product that cannot be replicated in TradFi, basically, because it's payments,
Yep.
And there are a lot of things like that, even touching right now the programmability of stablecoins, okay? Because we still couldn't figure out how they are best used in cross-border markets as a replacement of the US dollar. And we are not even talking about the programmability. And that's a huge deal, huge thing behind that door. We didn't even knock at that door. I mean, people are doing all that stuff in, staking, farming, but it's all in the, fringes. It's all decentralized finance that has nothing to do with payments, okay? That's not where the money is. I mean, compared to payments, that's not even a rounding error. It's just negligible what DeFi does right now. So the mainstream is not there yet. So people who are doing this are still trying to figure out how to integrate stablecoins in a very basic way to their flows without violating any regulations, without losing any banking relationships, etc. And that's what companies like BBNK, Keyrails, Milos, other couple Hi-Fi, and some older ones like Zero Hash has been doing for some time, actually. So we are getting all this behind some easy to use UXs. In some cases, Keyrails, allows you to do payments, stablecoin payment, without ever touching the stablecoin per se. And sometimes we allow you to touch it because you want to touch it, because you are accustomed to it. So there are a lot of flexibility around that, but we haven't even scratched the surface yet, because stablecoins are actually a paradigm shift, but we are using the most base layer, trying to understand that how do we use it in cross-border payments, which is not the biggest one, actually. So
I want to double click on I'm learning so much right now, by the way. I love my job doing this. I want to double click on the word like quantum layer that you use, just because that framework, not like that's a perfect word, but just like the paradigm shift of thinking about the unit of account living on a blockchain, a global system, a non-government specific system, because that's essentially what you're getting at, is the traditional fallback system of putting and custodying the currencies within these legacy frameworks, and then having to take them in and take them out and put them in and put them out. And like, that is where a lot of the friction comes. And so it sounds like for you, your perspective is, let's not focus only on thinking about stable coins of getting in and out of those systems. Let's think about stable coins as like a layer above that system.
Exactly.
That can be used as a store of a unit of account or system of record. Tell me, when you think about this season and some of the focus areas that we have here for this season specifically on the show, is just the idea of like security and the rails in which these systems are built, how you think about those things. Obviously, what we're talking about is a very, very incredibly important architecture to get right. Getting it wrong has incredible consequences and severe
we can't get it wrong.
things. You can't get it wrong. Otherwise, like you would be
We can't get,
obliterated. Like it just, there's no,
it
so
will be a
how
shame
have
to
you
get it
thought
wrong.
about, how have you thought about architecting this system? You know, it sounds like you have some exciting initiatives coming up with Anchorage and just these other things, but take us back a little bit into more of a simple look of how you think about the architecture. How is this actually built high level from a, you know, if you were giving like a master class to high school or college students on like how this all works?
So the fundamental of payments are routing. So you need to be able to route any kind of value. It doesn't have to be money. You have to be able to route any kind of valuable asset, okay, on the medium that they live in. If the medium is a clearinghouse, you have to be able to move money really fast in a clearinghouse, what we do, especially in the US. If it's a blockchain, it has to be like that. But now you have to do something very complicated. You know, you are moving value between two people, two entities. Now, that's a whole different ballgame here. Okay, so stablecoins are becoming the fundamental layer of moving value. So last night I was pulled sort of, you know, by trapping into a discussion about real world assets. Okay, so you know, when you think about real world assets, so BlackRock is saying, pushing the SEC to release all that, you know, stocks, bonds, everything on the tokenization side. And they did their homework. They are not pushing for, you know, real estate tokenization, which is like harder to do than, you know, terraforming Mars at the moment. From the legal perspective, it's a mess. But, you know, stocks, bonds, they are basically analog, you know, smart contracts, because they are all business contracts. Analog business contract, that's stock, a bond, everything is a business contract, basically. So it can be easily transformed into smart contract. It's the same thing. So the problem with that is, if you don't have the medium of exchange moving around in the same level, it's just useless, because the whole point of tokenization is the secondary market. So I'm tokenizing a bond, it all starts floating on the cloud, and we need to start trading it, not just P2P, but without intermediaries. You selling a stock to me, and it's exchanges hands. Like we tried to do that with NFTs, as you remember. Now it's getting more serious with bigger markets. That was just an experiment, but this is now serious, and you have to have the stablecoin. So we have to make the stablecoins work, because otherwise the counterparty is going to P2P without an intermediary, okay, underwriting both sides, which is the whole point. Without that intermediary, nobody's underwriting. The whole security system is underwriting the entire thing. So we have to have the stablecoin in a very secure way to eliminate this counterparties, or at least to mitigate it in a level, into an acceptable level, like you would do in a prime brokerage, for example, that is working on top of a clearinghouse. There is almost zero counterparties in a US clearinghouse, basically. So it's always non-zero, but it's very close to zero. Okay, so that's where we have to go. Okay, I mean, the entire tokenization thing is the mother lode of all crypto. Okay, stablecoins is just the beginning. That's the tokenization of money. But we have a lot of other valuable things to tokenize, you know. But none of them can work without us getting the money thing right, you know. So it's of utmost importance.
How would you help us think about the relative opportunity of what you just said? Like if USDC is tokenized money and all of the other things that you think will be tokenized with this, if we get this right, then we can focus on these other things. Like how big of a pie are we talking about? Like what would that in your mind even look like? I mean, relatively.
I don't even know, to be honest with you. I mean, from the volume perspective, payments alone. And when I say payments, people always think like it's $150 trillion. So B2B is 150 trillion, like 130, but going to 150 and stuff like that. That's just 10% of payments, because that's private payments. Now you have all the government payments, all the military spend, all the, you know, all the pension funds, etc. That's not counted in that, because that's public payment. So 150 trillion is like about 9% of all payments. So the all payments is like, it's in quadrillion dollars, and that's just payments. Think about that. There are a lot of other stuff that is valuable that we can play. So think about programmable gold, okay, where you don't have to, you know, hold gold, basically. Tokenizing gold is a huge thing, because it's already there, because it's accepted by everybody. It's just the tokenization that we have to do. But we can't do it without getting the stablecoin right, because we have to buy and sell it. And buying and selling is all about, you can't exchange it per se. You have to have a medium of exchange. That's what we learned over the past like 4,000 years or so. Okay, you have to have a medium of exchange, and so that's why we have to get the sale. So it's like quadrillions of dollars of value transferring, and not just that. There is so many limitations that we do with all that value. Right now, there is $430 billion credit deficit in Africa. 450 billion. Let's say 450. Let's say $500 billion. Okay, just the same thing. And we can't get credit to those people. They are the same species basically. We can't get credit to them fast enough. Okay, because we don't have the tools. When we build the tools, we lack the rails. When we have the rails, we lack the necessary risk tools to gauge the risk, because all that data that what they are doing, like a farmer, for example, doing farming in Kenya, they're not digital. Okay, we don't have their data. How do you underwrite that? Okay, so what we are talking about is tokenization of all that stuff that a machine and AI can just underwrite in a microsecond. All of a sudden, at $500 billion newly minted credit is flowing into Africa. Okay, now that's efficiency. Okay, we are not doing this because we can't, and because we are just stupid people who don't know how to do it. We know how to do it, but we don't have the tools to do it in a legal way. Okay, it's just so inefficient. Okay, I've been operating in Africa for some time, and talk to anybody in Africa that talk to Chris, yellow card, talk to Pink Card, talk to Flutterway, they will all say the same thing. I mean, when we on ramp, okay, through our partners in Africa, the first question we ask is, where are you banked? Except for Nigeria. Nigeria has RTP, so they are very, very sophisticated. But in Kenya, for example, where are you banked? If you are not banked in the same banks that I am, okay, the on-ramp doesn't work because it takes 2 days, 3 days to move Kenyan shilling to another account, intra-bank model. This is true. For example, in Nigeria, the fastest way to move money from Nigeria to Ghana is to drive it. So you go to an ATM, pull the money, put it in the bag, put it in the back of your truck, and drive it all the way to Ghana. It goes there faster than a bank transfer. Okay, that's the system we are operating in right now. Stablecoins are not enough. Okay, because like I said, all these value are basically business contracts. Okay, there are why am I moving money from Nigeria to Ghana? Am I a crazy person? No, I have a business contract. Okay, I have liabilities. I have to pay that. I have debt. Okay, because of a business contract. I need that contract online. Okay, in the cloud, and stablecoins on the cloud, so they can match. Okay, I have the contract on the analogous side. I have the stablecoins, and I have bank accounts that can move money. Okay, I have 3 systems right now. Okay, that can talk to each other. Of course, it takes 2 days. Of course, it takes 2 days. US is the biggest financial market in the world, the richest country in the world. ACH still takes 2 days, sometimes 1 day, sometimes same day, but it's still very volatile. I mean, okay, it takes US maybe a decade to get a FedNow system. It's still not very mainstream. Still, payroll runs on top of ACH still. Okay, so these things are very difficult to build, but the only way to do them properly, if it's going to be meaningful, because if we can't do it like 20% better, it just wouldn't work. It just has to be a paradigm shift. We now have the paradigm shift on the stablecoin side. We just have to get it right, so we can pull all the rest to the same paradigm shift, to the same paradigm, so we can leave all that analogous stuff behind us as human beings, because that's just very beneath us right now. Because we do all this work and we do all this stuff, all these businesses in Kenya, Nigeria, Ivory Coast, they are coming to us to get just paid in the US. It wasn't possible. This is why Bridge got to $1 billion. I know Zach for a long time. I mean, they weren't very useful before they got with their agreement with Lead Bank, and they were able to, to offer all these USD virtual accounts. Okay, and they expanded that to emerging economies. All of a sudden, they got it to $1 billion. You know why? There is a thing that nobody talks about. Lead Bank CEO, and I know her, Jackie, okay, is also in the board of Nubank. And Nubank is the biggest neobank in the world. In Brazil, in Latin America, she already knows the emerging market. That's why she allowed Bridge to operate in Latin America And then Bridge brought us to Leadback, and we convinced them to work in Africa too. That's how this whole thing got, you know? We convinced them. They weren't doing Africa until they met us. We told them Africa is just like Latin America. It's just a bit, harder to crack. So we need you guys to support us. That's how we got into it. And that's how we created all this system, which resulted a very well-deserved $1 billion on Bridge's side. It's very underestimated how Zach pulled this off and their Bridge team. It's very underestimated. Everybody thinks, oh, they just got lucky. No, well, luck always plays a role when you're going to a unicorn route, but they created that through right partnerships, and they were in the right place at the right time. Sure, and Leadback and Jackie was a big thing on their side. But, that's how hungry people were to get a USD account, not to just get payment from their Amazon shop. Just to get a payment, because Amazon forces you to have an ACH-enabled named USD account whose name matches the Amazon shop name, because otherwise they have to get MTL licenses, transmission. That's how US regulation works. So they can get all the payments on one side, but since they got all the payments from one side, they can't do it on the other side because it's third-party transmission then, because you are intermediating the payment. Now, Amazon needs that to be a first-party payment, to, not to be obligated to get their MTL license. And US is very, very hard to get that because you have to get them in all 50 states to operate that. So all the marketplaces like Etsy, Upwork, Fiverr, Amazon, Shopify, everybody gets the payments from the end customer. That's how they make their money. And the payouts always have to go to first party. And Bridge got in the way. Bridge provided all that USD accounts, and they got gorgeous. They got incredibly and very well deserved, because all these Latin American companies, all these African companies, all the Turkish companies, there is a Turkish company called Senoa. Okay, they do non-custodial wallets, and they recently signed in the last 3 months, they signed 4,000 import exporters out of Turkey. Okay, to open a USD account via Bridge, because they are already in business and they are paying so much money for these, fees and all that stuff, because they are resourcing all that material from China, trying to send a payment from Turkey to China. It's really hard to do. It's really hard to do, but all of a sudden they have all these USD accounts that coming in the stablecoins, and they are using us to push all the payments to China. It's overnight and everybody's very happy, and it's 1/10 of the cost. What we are doing in Nigeria compared to the banks is 1/4 of the cost to Nigerian banks. And they take 10 days to send a payment to China because it takes them 3 days to source the US dollars. We source them the same day, and we do overnight payments to China. So 1/10 in time, 1/4 the cost, okay, through Keyrails from Africa. That's a huge thing. And that's only possible through the right use of stablecoins, which Bridge did, combining them with a USD account, okay, a named USD account, not a pooled account. Pooled account won't work. It's a named USD account with a USDC stablecoin behind it. It solves like a dozen problems in one stroke, because you are not holding USD. Now you are not suffering from ACH fraud. You are not suffering from chargebacks, because from the bank's perspective, you already bought USDC. You have already bought the asset. The transaction is terminated. So they solved all these problems with just saying, we are not going to hold USD. Everything gets converted to USDC. And we are not going to hold USDC either. Just give us your, infrastructure wallet, okay, an address. We will send it there. That was a genius model, and that solved a lot of problems. Every one of us are following that model right now, actually, and they are converting. Bridge is converting back to custody model, because they are Stripe now. They have to think big, etc. They can't be laser focused anymore. But they changed the pace of stablecoins, actually. But this wouldn't be possible without Trump being president, having the Mjolnir in his hand and giving orders right and left. This is all one big tsunami that we will remember, that we will cherish this moment in coming 5 years or so. We'll look at this moment and see that was the tipping point, and that was very necessary. Okay, and we did right. Okay, I'm 100% sure of that.
It seems like since with the model of having the named account structure being what is being implemented, because of that, the asset can remain on that quantum layer in kind in stablecoins, which allows it to kind of remain in that level of your mind of like it's still there.
And it's incredible because now you are shifting the risk from the bank completely to that quantum layer. Because if you leave all that USD dollar, we saw what happened with, Snaps and Evolve. If the bank assumes all that risk from an African merchant, which is, a big risk from a US bank. And it's not a OCC. We are not talking about an OCC, a licensed federal bank here. It's a Kansas State bank, lead bank. It's not exactly JP Morgan, They can't take that kind of risk. So bridge model worked perfectly for them. And it allowed them to expand so big because, the payments is coming, but they are using the virtual accounts as processing layer, not as a custody layer. They shifted the custody to that quantum layer as USDC. And they asked the client, can I do that? And client said, yeah, but it is risky. The client said, I will assume that. The client has taken that risk from the bank's hands, okay? The FDIC risk, the insurance risk that the bank has to carry for each of these accounts, $250,000 per account, okay? But the client has taken that risk from the hands of the bank and put it on their own books. The bank got rid of the risk because they got rid of the USD from the custody. It's an incredible model when you go deep dive into it. We should all follow that model.
It sounds like you are following that model in Africa.
We are following because it makes so much sense. We are going to every bank and we are telling them, I can't name any banks because, we got approved, but it's not live yet. But we got some tier 1 banks which show them this model that we are Bridge's model. So we do a lot of work with Bridge and business with Bridge. So we showed them the Bridge model, okay? We said to them, we want to replicate this, okay? And you won't hold any USD. We're just going to use your ACH and Fedwire, and we got rid of. And ironically, we put Bridge on behind of that. That was some clever move from us, but we did that, and they approved us. They wouldn't have approved us because of our exposure to emerging economies. That's how we are changing this model, And Bridge started that, so they deserve that $1 billion. I hear some people that they are a bit, overvalued or something. They are not. They are actually undervalued. Wow. They are the Instagram of financial services. Okay, They are the exact same thing. Okay, Instagram 1 billion overvalued. Now we are seeing, it was the best investment that has ever been made. And Stripe will do the same thing. They will look back. And I'm hoping that Stripe doesn't do its normal Stripe thing and leave Bridge be and, expand on that model to other currencies and stuff like that. So we can do more good work with them, but time will tell. But if they do it, they will be, model will work very well with other currencies too, because the banks will love it. When banks love it, everybody loves it.
Yeah. Give us, just as we close here, this has been really great. I've learned so much. There's so many layers to this. And, the perspective you have on how you see all of it fitting together and knitting together is really wise. And I'd love to, I think we should definitely, I want to have more of these conversations just because I think there's so much nuance here.
Yeah. Anytime
Give us just specific with Keyrails. Like I want to be I would hate for someone who's listening to this to leave the episode and not feel clear on Keyrails specifically. Like I know right now, I think we've talked about some of these longer tail future things that are really exciting that you're building. How does this take shape today? Like right now, your sales teams, your customer conversations. I know there's a ton of stuff you're doing with Swift. You touched on. What is the high level pitch currently of Keyrails? Who are you currently working with?
The high level pitch is we are connecting the fragmented financial infrastructure of emerging economies to the highways of the developed world. When I say highways of the developed world, I mean New York, London, Singapore. Okay, that line. Okay, we are connecting all that infrastructure to there via stablecoins. Basically, that's what we do. And our chiller product right now, which came into product market in record time, actually, and growing really, exponentially, is Keyrails Global Connect, which is basically a best-in-class Swift product that can be triggered from a stablecoin treasury. So normally, when you are using stablecoins, as you know, you have to first off-ramp, first party. So you have to have a bank account. Okay, so you first off-ramp and you have to wait for your liquidity provider to send that USD to your bank account, which takes like a day or two. And then you can order your own bank, the Swift. Now, that's a very, very bad infrastructure, okay, from a couple of reasons. One, it takes very long. It's very expensive to do that. Two, if you push stablecoins all the way to the emerging markets where your target market is, termination point is, it will be very expensive on the conversion because they lack all the liquidity. The only liquidity that is relevant is the US liquidity. So you try to convert USD to USDC and vice versa in the United States. But then you have to find a way to route all that USD. So we built a ginormous amount of infrastructure in Southeast Asia, Dubai, Nigeria, a lot of bank accounts, a lot of liquidity partners, and we got very, very good at routing those dollars. So you don't need that middle USD account. You can just instruct us a third party large value payment. Our average is like $225,000 per transaction right now. And we will do an overnight Swift for you on behalf of your merchant. And we will change the Swift message, okay? Customize it, change the sender name to your merchant's name, okay? Which we call a POBO Swift, which is payment on behalf of Swift. Only half a dozen companies can do that. We are one of those companies. That's banking grade Swift. That's what banks do in Swift. So you are always the sender. If payment companies do Swift, it's always a payment like PayPal, for example. When you get something with a Swift from PayPal, the sender is PayPal. You look at the memo on your bank statement, then you will see on behalf of whom PayPal sent that payment. In our infrastructure, the sender is the original sender, not our clients, not us, not our partners, nobody. That's the original sender. So that's a beautiful thing to have, because if you are an importer, you have to present a payment of proof of payment to your customs to pull the merchandise. There is nothing better than showing an empty message, Swift message, the original Swift message to customs. When you are showing that, the sender name on the Swift needs to match the importer who is pulling the merchandise. And that's what we do. We actually upload all the original MT103 messages to our dashboard within 1 to 3 hours after we do the Swift payment. Okay, so our clients can download that and give that to the importer so they can present it to the customs as a necessary documentation. So we do all these little things, but the giant thing is we are ridiculously fast and cost efficient when connecting Swift to stablecoins, basically. And that's our killer product right now. So, and we have 90% of our customers are from Africa, because and we do a lot of payments to China, Taiwan, Indonesia, to the Southeast Asia, because that's a $250 billion market from sub-Saharan Africa to that region, basically. It's actually more,
Wow.
but that's our beach market.
Wow, that's exciting. There's so many different layers to this. I thank you for your time. I love what you're doing. I think for you, it's so obvious that you're building with a customer use case in mind, like clear one. And I'm really excited to see what this year brings for you guys. Any final thoughts for anyone listening, wanting to follow you, get more involved? I see you're pretty active on LinkedIn with some of these takes.
Yeah, I decided to get all that information out there in written form because, people on LinkedIn like me, like written forms. I never watch videos on LinkedIn, almost never. I mean, I watch like 10% of the videos maybe, but I read everything, especially from very specific people who I follow. And I
Who are you
decided to
following
share
right now that you like to follow? Like who's putting out stuff like this that you like?
I follow Eitan from Nilos, the client of ours. He knows what he's talking about. I follow Bradley Riss, who's an investor at Keyrails. I follow McCune. She is the payments royalty, and then it comes to B2B payments. I follow a couple more people that I can't think of right now on top of my head, but they are all related to payments. I follow Faisal Khan, who actually taught a lot of things that, I know Faisal since 2017 maybe. And he taught me about all flow of funds and how cross-border works. And these are really, really old school emerging market cross-border payments guys that taught me how things work on the below the, water level,
Sure.
the very deep trenches of the ocean, how money exchanges hands and what systems are being used. For example, US hosts by far the biggest international payments clearinghouse in the world, which is called CHIPS. When I say CHIPS, to even the American payments people, they have no idea what I'm talking about, which is incredible, because all the payments that goes out of the United States actually is cleared in CHIPS, which is like clearinghouse for international payments. Very, very nice acronym. So
yeah.
They have no idea, because it's a very base layer, that's a system JP Morgan uses, And nobody knows that because everybody knows JP Morgan. Nobody looks behind JP Morgan or Citi
Yep.
or, or BMY or other big banks in New York. So, but we do, because I'm a very curious guy and I love this business, moving money around. And I really know these systems. I know Nacha and how I know what Nacha file looks like and how ACH works, how FedWire works, and how PIX works, UPI works, how they are different from Fed now, and all that stuff, because they are necessary. They are absolutely necessary to know. And I know how to get access to those. That's very, very important too. And the reason why we built Keyrails actually is we know all that stuff. And there is no chance that every other people can know all that stuff, because they have to spend a lot of their, kids' time and read all that, very, very boring thing, and watch Fed videos like me, 40-minute Fed videos like me, and watch them like they are watching Lord of the Rings. So we need to, yeah, I do. I'm a nerd. I'm a famous nerd. Sorry. And we said we need to build something like a Keyrails and get all that abstraction, build an abstraction layer so we can build all this thing with all those base layer systems, and we already know how those systems should interact with stablecoins because of very, very painful memories and experiences in the Philippines, Mexico, and stuff like that. So we already know how to do that and what works and what absolutely doesn't work. So why don't we build this and build an abstraction layer so people can just connect to and make those payments and just build their businesses? That's all Keyrails is about. And most important markets that suffer from this are the emerging markets, where like 90% of the people of the world's population live. And I see a lot of stuff on LinkedIn right now that says, my daughter has a DBS account in Singapore and I bought Bank of America, okay, and I just sent her $1,000 and it just got there in 10 minutes. Why would we need stable coins? Great, you belong to the very lucky 1% of the world, okay? But we have to build for the 99% of the world, and just they don't have that kind of access to those tier 1 banks, unfortunately. So Keyrails is all about getting all that obscure infrastructure, the back alleys of the emerging markets, to the highways of the financial infrastructure, which goes through New York, London, and Singapore, basically. So that's what we do.
Makes sense. Awesome. Berhan, thank you for the time. Absolutely. We'll do this again.
You're
really
welcome.
Appreciate it.
Yep, sure.